Greetings, everyone. My name is Amol from Latticework Investments. Hope everybody's doing well and staying safe in these crazy times. And, this week's been an incredible week for Chinese markets and for Chinese stocks. And the word on the street, or the word on Wall Street, is that the government, or the Chinese government, is telling its citizens to buy stocks. And that's why these stocks are doing so well. So anytime I hear these narratives, the natural tendency is go look at the facts, right? And I've already done that. It would just turn into the latest edition of the dark arts. And this one is titled Scaling the Great Wall. So let me fire up the presentation and let's get started. Before we get started, here's the disclaimer. This video is for educational purposes only. There are no recommendations in here. And if you have questions, please reach out, latticeworkinvestments.com. Before I get started, I just want to give you a quick story. For the first 8, 9, 10 years of my investing career, I was a very big skeptic on China. I didn't believe the economic numbers. I thought the country was building, bridges and railroads to nowhere, and there was really not any economic value that was added by all these activities. Until 2015, I got very interested in the Chinese internet economy and the companies, and I studied them for a long time, which actually brought me to China in 2017. And I'll tell you, I was blown away when I visited China. It's more advanced than any advanced economy in the world. And they've done an incredible job of building all these things. And this is a picture in Shanghai. And the background is Pudong, which in the late 90s was literally a waste ground. And they've built an entire financial district. And there are many, many examples such as this of building just entire cities from nowhere. And the reason I bring that up is because I know today China is enemy number one, but as investors, we have to keep all these sort of emotions aside and just focus on what's in front of us and look at the facts. So with that, what is the message from the markets? And let's start with my favorite Yogi Berra quote: "You can observe a lot just by watching." And what is it that we're observing? And there are many different themes in it. It starts with the dollar, which is now stalling, and the reason it's important because we know that currencies and equities always move in tandem, right? And now we're starting to see, along with the dollar stalling, we're starting to see real improvement in the relative strength in Chinese equities. And that's happening because fundamentals are improving, right? COVID's very much under control, and the overall valuation of a lot of these Chinese stocks are actually very reasonable, definitely compared to what's in the US. So here is sort of a 25-year view of the US dollar. And it's, as you might notice, that the dollar moves in these 7-8 year cycles. Why, I'm not really totally sure, but you had a very weak dollar, mid 80s to sort of 1992. Then the US economy really gained a lot of strength in the mid and the late 90s. And you had a very, very strong dollar. Then you had, a weaker dollar from all the way from 2000 to 2008. That was a commodity cycle. And then after sort of this consolidation, you've had, again, a very strong dollar starting about the European crisis, 2011, all the way. So that's coincided with a very, very good decade for US companies, right? But when you take a closer look, this is the last few years. As you can tell, the dollar sort of run into resistance here, and it's now weakening. And there's some economic reasons for that. Obviously, one is our deficit is now starting to widen, right? We're spending money that we don't have. And that's probably getting exacerbated now as COVID has brought in a lot of Fed money printing, a lot of stimulus, a lot of those things, those type of things, which is, I think, affecting the strength of the dollar. And it's important, that context is important when you look at this slide, right? So the top is the US dollar versus the Chinese yuan. And the bottom is just the S&P 500 versus just the large cap Chinese ETFs or the Chinese market. And as you can tell, when the dollar is weakening versus the yuan, the S&P weakens versus the Chinese stocks. When the dollar strengthens, the S&P 500 does better than the Chinese market. And this is the sideways move, right? So there's a lot of interconnectedness between currencies and equities. So let's move over. This is the reason I want to show you a few of these Chinese ETFs. These are just, broad Chinese representation of the market. And this is the GXC. And as you can tell, this is the peak from 2008. This is right before around the Chinese Beijing Olympics. And these stocks have gone nowhere for the last 12 years and are just starting to kind of break out of this consolidation, which I think is very bullish. The GXC has a lot more tech in it. So you'll see that this ETF has done better than some of the other ones because it has more tech and less financials. And that's sort of been the theme for the last decade. Tech's done better than financials. All right, this is the A shares. They have gone nowhere in the last 5 years or so. And that's because they have a lot of financials in them and not a lot of tech. All right, this is the MSCI China. This is better than the A shares. It's got more tech, less financials, right? And then you have the FXI, which is really the top 25 large cap Chinese companies. And this is half financials and a lot less tech, right? And now that you've seen these ETFs, let's look at a relative performance, right? So we're comparing now is China versus the USA, in this case, the GXC versus the S&P 500. And look, it's been literally a decade-long underperformance for Chinese equities, right? And you've seen that. You've seen sort of this bot shallow out, and now you finally starting to see Chinese stocks, in this case, the GXC, starting to do better than the S&P 500 right here, right? So COVID has something to do with it. This is the MSCI China, MCHI versus the S&P, same thing, decade-long downtrend where the S&P has done better, and now you're starting to see Chinese stocks, in this case, the MCHI, do better than the S&P 500. Here is the FXI versus the SPY, same trend, starting to see better, right? So the question really is, what's causing this trend change, and why is it happening now? So the only way to find out is to go look at economic data, fundamentals, see how the economy is doing. So let's start with money supply. This is the amount of money that's available within an economy, right? And when you look at this chart, look at 2008. This is the great financial crisis. China pumped a lot of money into the system, really helped the whole world by doing that, right? The money supply is up 30%, and you see that correct over time. In 2015, China, this was probably the weakest spot of the Chinese economy. They pumped a lot of money in, helped things get going. And by the time, early 2017 came around, there was a lot of speculation in the property market in China, and the government actually tamped down the money supply. And as you can see, the money supply was then growing at the slowest rate in more than 2 decades, at 6-7%. And then finally, COVID, you've seen stimulus coming out everywhere, and so is China. So that's one reason, right? So money supply is now increasing, which is the fundamental factor for any growth in any economy. Then we can look at the yield curve. This is just the yield curve in China, so long rates versus short rates. And while the yield curves were inverted pretty much in most other developed countries, that wasn't the case in China. It wasn't great, but it was still flat. And then as 2020 has come around, you start to see an upward sloping yield curve, which means the banks actually make more money by lending, because the long rates are higher than short rates, and that's how they make money. So that's actually a good thing for economy, because it sort of adds grease, right, to the wheels, that it helps growth. Let's look at the auto market in China. It was growing very, very strong the first half of the past decade, right? As I told you about, reducing the money supply obviously affected auto sales, which then were barely growing then in 2017-18. This is the trade war and the impact from it. And then, of course, this is COVID. And now you've seen, a real rebound in Chinese auto sales. Now they're up 7% year on year. So this is, another example of money supply and low and availability of financing helping the economy in the case here, auto sales. This is new orders. New orders obviously fell off a cliff in, sorry about that. This is just Siri listening on me. So new orders fell off the cliff. Again, it's not so much to do with China because its trading partners were shut down at that point. And now you're starting to see, as the rest of the countries open up, you're starting to see new orders starting to improve. Here is just the manufacturing PMI fell off a cliff, and now actually it's above 50, which is a very positive sign, which tells you that manufacturing is growing in China. This is the services sector, right? Half of China is manufacturing, the other half is services and a consumer economy. And services now are growing faster than any other point, literally over a long period of time. So that's another reason for optimism. Retail sales had been growing 7-8% for many, many years, right? Down 15% early part of the year, and now have rebounded to down 3%, and I think they'll grow positively in the second half of the year. This is just the online component of retail sales. This is total retail sales referenced in the previous chart. And here you're seeing these lines grow up, move higher, and total retail sales are up, right? 22% in the month of May. And a very important factor today is while we are struggling here in the US, especially with rising COVID cases, China's, after that initial big move, has seen no real change in the number of cases. So COVID's very much under control. And that's an important factor because a lot of other emerging markets aren't doing as well. India isn't doing as well. Brazil isn't doing as well. So when you take all of that stuff and then you think about, an improving economy, accelerating fundamentals, and then you look at, one metric of valuation, in this case, the price to earnings ratio, it's lower than lower than any time it's been in the last 10 years when you just compare it to itself. And it's definitely lower than most of developed markets, and it's half of what the American markets are trading at. So you take an improving fundamentals, cheap valuation, and then let's look at the Chinese market, which in itself is really very much a feast or famine market. I'm not really sure why that's the case, but if you look at sort of the last 20 years within China, you've had these like periods where the market's really done nothing or it's gone down, and then you've had just incredible periods. So look at this 15 months between early 97 to mid 1998, the market was up 180%, and then you had nothing till mid 2005, and then over the next 24 months, the market was up 450%. You did nothing. The market did nothing for many, many years, and this is 2014 to 2015, up 150%, and then you've had nothing for the next 5 years. So whether that we see that type of performance going forward, I'm not really sure, but I think the performance based on everything that we've seen is definitely lining up to be better than, on a relative basis, than most of other markets. So we've gone over a lot of data, right? What have we observed? The dollar, which is critical for emerging markets, for China, is slowly starting to get in its favor because it's now not as strong and is stalling out. We know currencies and equities move in tandem, so that's positive. The relative strength, again, is after underperforming for more than a decade, is starting to move up, right? So let's ignore the narratives. Generally, the economic fundamentals are improving, right? COVID is under control, and the valuation for the market is reasonable. So for an investor, you want to own the best companies, in that will be the best markets, right? And this is definitely, I think, a case to be made for China to be one of the better markets going forward. And based on all the data that we've seen, I think a major shift is definitely underway. So um, that's all the data I have. That's the dark arts scaling the Great Wall. Hope you enjoyed the video. Hope you found the information to be something that you can use yourself. So that's all I have. Thank you for watching, and talk to you soon.